All right, good morning, everybody.
Good morning.
We've got two pieces of business that we're going to accomplish this morning. Between now and 8:30, we're going to talk about our usual Brown Advisory stuff. And at 8:30, John Coffey, who we talked about last week, is going to join us. And he's going to talk about the intersection of sustainability, ESG, SRI, corporate governance, however long we like to frame it, or whatever terminology we like to use. The convergence of social impact and investing along with what we do, which is managing the investment portfolio. So having said that, a lot has transpired since our class last week. Who'd like to take it from the top? Tim.
We got our monthly report back.
You get a star.
What is that?
That's at the top of my list. All right? Most important thing, tell us about our monthly report.
We outperformed the S&P again,
Awesome.
and we broke 900,000, which is a high for us, obviously.
Absolutely.
We added about $30,000, which is one of the biggest jumps we've seen. Spent time in part of the Brown Advisory, but I think probably of all time, it's one of the bigger ones. It's been growing really well for us, and continue to grow at between 2.5% and 3.5%. Doing pretty well.
Absolutely. Anybody have any other comments to add to that? Anyone? Trash. A question about? Oh, let me get to that. All right. We start with the good, then we go to the bad. There are a couple things that you said that I sort of want to add on to. First of all, I'm especially happy that that's the first thing that you talk about. When this fund started back in 2008, I think it was funded in June of 2008 with $500,000. Obviously, there was a little bit of retrenchment in 2008, 2009 with the market meltdown. But basically, we've now crossed the threshold of $900,000. And that's without any new coming in. And that's a reflection of the work that you folks have done this year, plus all of your predecessors. And what I think is interesting about it is that, from the perspective of we outperformed the S&P this past month again, which is great. Year-to-date basis, our fund is up about 24%. The S&P is up about 20.5%. So we've outperformed the S&P by 350 basis points. Which is really great, and again, a reflection of cumulative work over a period of years. In crossing the $900,000 mark, what's most impressive is that's the power of compounding. And so that as fund assets grow as a result of performance, the good news is that when the S&P is up and our fund is up, we're going to do very well. But again, the power of compounding is that when the market goes down, it's sort of the inverse of that as well. But I think, again, it's very important, and that certainly is a good place to start off the morning. Other news stories, and we will get to that as well. Other news stories. Yes?
The Republican tax plan passed,
Okay.
and also legal for expired.
Talk about that for a second, Laura. How about
Well, it passed at like 2 o'clock in the morning,
Yeah.
and I think it was 49
Right.
So I don't really know what happened next. I guess like it's just passed.
Okay.
And a lot of people were like talking about how it's not going to trickle down. Like we talked about that last week, how all these companies were like actually no, we're not going to put that happen anywhere.
Okay.
But it's like the first like victory for Trump's administration, like all of the stuff that they promised they would do.
So what do you think that means for us? Because as I always try to point out that we try to be agnostic in investing. What do you think the tax plan means for us as investors?
I think as investors, it's good because like, how they said that they were just going to put it back into their own company. That's good. But we don't like, as investors, like as people though, you don't have as much like disposable income to invest yourself, but like we work for investment funds.
When you look at the S&P 500 going back 6 months, and obviously as we just talked about our performance relative to that of the S&P 500, obviously the market has been turbocharged since the election. The market has been turbocharged really for the last 12 and a half months. And certainly as you look at the performance of equities over the last 2 weeks or so, as this legislation has been making its way through Congress, it certainly has been a positive for equity prices and for equity shareholders. And that's us. So again, what we have to do is we kind of have to dissect what's in the tax plan, whether it makes sense for America, whether it makes sense for corporations, and to be able to participate in that. So obviously, we've been an active participant in that trajectory of the last year and certainly of the last week or so. So the question is now the House and the Senate are going to get together to see what form that takes. But at the moment, for reasons we've talked about in the past, it looks like it's a real positive for stock prices. Other news stories. Yeah.
Question. Yesterday I saw after the market closed, Blue Buffalo was up like 10%, and then it, like within like 30 minutes went back down. I'm not sure like if you know what that was about.
I didn't see any news stories on it.
Yeah, I couldn't find any like story headlines or anything that I looked up.
The only thing I can say is, again, looking at this, is an analyst, being positive on the company. And secondly, there is a news story here, which I'm not familiar with. Some of the companies that will benefit from the tax plan, again, which we don't know what all the components are some, as I would refer to it, sort of off the beaten track proposals that are in there, such as craft breweries. Now, whether somehow Blue Buffalo fits within that same category, I don't know, but I think it's something we can, kind of discover as there's more news information in the next couple days or so. In moving a bit farther, just with a little bit of housekeeping, what I would like to do for our next meeting in January, and Tim, if you could take the reins on that, I'd like to have a series of reports to be able to put up on the website. Number one would be to talk about, and again, a short commentary on our performance relative to the market, how we did it. Secondly, I'd like to, Olivia, if you could give us a short little 2-3 paragraph report on Blue Buffalo, why we bought it, why we added it to the portfolio, if we're pleased with the performance on it. And Shresh, if you could do the same thing with regard to Polaris, PLD. Obviously, the stock has acted very well since we bought it. Other news stories. Yes.
So we bought Bryn Mawr Trust last spring.
Yep.
About $10,000 to $15,000
Yep.
worth of shares.
Yep.
And they just acquired Bank America,
Mhm.
which that's just kind of news. And so they're kind of expanding into New Jersey a little bit, whereas they do primarily in southeastern Pennsylvania and Delaware.
Mhm.
So they've done a lot of acquisitions in the last year, and people thought, or they even thought they were going to kind of slow down and try to catch up to these acquisitions, but they actually just acquired it.
The stock has acted well since we bought it. Financial services stocks, banks specifically, have acted very, very well in light of the proposed tax bill. They certainly will be a beneficiary of it, and Bryn Mawr Trust has been a beneficiary. On the other side of the coin is Eagle Bancorp. And Shresh, if you could just give us a quick download as to what's transpired in the last 3 to 4 trading days with Eagle. I'm sorry? Okay. Austin? Okay. Anybody else follow Eagle Bancorp? Okay. I do. And one of the important things that you must keep in mind is that when we buy a stock, stocks trade every day. Stocks in the U.S. trade between 9:30 and 4 o'clock. There are news stories every day. Just as you follow your favorite team, whether it's fantasy football, fantasy baseball, fantasy basketball, the markets are really a 24/7 industry. There was, if you can look at the graph, and see what happened on Friday. The stock traded down from 66, 67. It traded as low during the day with a 46 handle and closed up from the low of the day. The stock was down over 30% for the day. What had happened, what transpired, was a short seller. Anybody want to give me a definition of what a short seller is? We always talk about being long the market all the time. What's a short seller? Yes, one.
Short selling is like when you think that a stock is going to do that, so you kind of like bet against it.
Correct.
Like you bet that it will do that.
Correct. And you short the stock. We go long stock by buying the stock, all right? And whether it was Polaris, whether it was Buffalo, we like the Eagle Bancorp, actually bought the stock in April. We liked the fundamentals of the company, we liked the management team, we thought the stock was going to perform well, so we went long the stock. What happened with Eagle Bancorp was that Thursday night, Friday morning, a report hit the wire of a short seller who made a series of charges against the company of insider trading, problems with loans, conflict of interest between senior management within the company and different lenders, different borrowers to the bank, and as a result, the stock went into a state of free fall. When the stock opened at 9:30, and I want to say it was probably about 20 to 10, a quarter to 10 or so, the stock was trading about 59 to 60. And I said, something is amiss here, even after having read this report. It's a very, very damning report. And I unilaterally decided that there's a philosophy that I've always lived by, and that is where there's smoke, there's fire. And whether this report is right or whether this report is wrong, there is something that is dramatically wrong with the way the stock is acting. And I'm sorry to say, but I called Harriet, the CFO who executes all our trades, and I said to her the same thing. There's a report out there. There's a short seller. I don't know if it's right. I don't know if it's wrong, but I think we have to sell the position, okay? So we sold the stock last week. Hopefully nobody's angry. We sold the stock around 54, 55 or so, which is essentially where the stock is today. It did recover a substantial portion of the loss it had last week, but it's still down substantially from where the stock was trading last week at this time. So from my perspective, what our role is to continue to monitor this stock and to see what news transpires. The bank came out with a statement. Actually, they came out with a couple of statements and stating that all of this information is false. They have a great system of internal controls in place, and that may be very true. This report may in turn turn out to be a bogus report. However, there are two issues. Number one, where there's smoke, there's fire. I'm very much concerned about that. Number two, this is a regulated industry. The financial services industry, specifically the banking industry, is a regulated industry. It's not a simple matter as a company, a manufacturing company, of overstating or understating its inventory, overstating or understating its sales, because they have auditors who will come in and sort of catch that sooner or later. In the case of a bank, in the case of a financial institution, yes, they have their auditors, okay? But yes, they also have the FDIC, the State Banking Commission, the OCC, the Federal Reserve Board, and I just think there are too many layers of people that may potentially investigate it. So from my perspective, we'll take a seat back, sold the stock, we'll take a seat, let's see what happens, and maybe this will all blow over and there are no problems, and we can then go back and make an evaluation and say, gee, we bought the stock originally at 58. It's now trading in the mid-50s. If we liked it at 58, it's now a little bit lower. Maybe we should take a second look at it. So that's quickly the story of Eagle Bancorp. Other news stories. Yes?
CBS conversion of
I'm sorry?
CVS Health.
Tell us about it.
So last Sunday, CVS Health and the pharmacy and Edna, the Christmas largest health insurance company, were both Sunday. And from what I can tell, they're all patient-based. So the hope is that it helps bring a higher level of healthcare.
Other thoughts anyone else like to add? Yes, Autumn.
Well, I'm from Rhode Island, and that's where CVS is like headquartered. And a lot of people like in Rhode Island have already said about it, and they don't think that it's actually going to be like that great for them because CVS like has had like not a lot of closures, but with Rite Aid, Walgreens, all stuff like that, they like are doing fine enough, but they don't have a big enough workforce. Like in-house and the actual headquarters to sustain it. And so now they're trying to hire more people, but a lot of people like are kind of shying away from it because they think that merging with that does going to make it too much work.
Okay. Yeah.
Two different questions. One, so the wildfire is going on in California.
Can we just finish this?
Follow this on.
Other thoughts on?
Monday.
Yes.
It's really a side note, but what they're trying to do right now is sort of they could be undercut by Amazon. A lot of people think that Amazon's probably going to get involved in healthcare, and it's going to have a pretty large effect on this business for them. If they can merge healthcare with the pharmacy, that's something that a lot of people are predicting Amazon will get involved in, and Amazon obviously being the monstrosity that it is, probably going to do pretty well in that market. So I'm not sure that this was like a great move for them, but I guess we'll see as we monitor the stock.
Yes.
I was going to kind of go off of what Tim said. I was going to say how like, hey, we're a little nervous with Amazon, with potential pharmacy market. But one of the big things I was reading was that by merging with Aetna, it might become a trend to work out with other pharmacies as well, because there's like out there's obviously unfortunately and merging with the house and insure will allow patients to go to the like have preferential pharmacy, which would bring in customers in because they're merging the cost their medicines to that pharmacy will be cheaper, and also that's something we're going to add thinking the education, like adding more like making the pharmacy more of a health center, like a community health center, rather than just being pharmacy dish out things and consumer items.
And at the end of the day, I think that's really what it's all about. If we look at healthcare over the last 10 years, and going back to 2008 to the election, obviously healthcare was a major issue, continues to be a major issue. And what we saw with Obamacare 2009, 2010, whether you like it or not, it's a new form of healthcare delivery. And again, we as investors are agnostic. We don't like Obamacare, we don't dislike Obamacare. This is what the healthcare system is we have today. How do you adapt to it? And so if we look at the face of retailing, and everybody is concerned, all retailers are concerned about Amazon, and all of a sudden when there are 1 or 2 quarters of bad sales, we need to have now a web-based strategy. And so what these two companies are doing are taking healthcare to the next level. It may work, it may not work, all right? But they're going to try to now bring, as you said, they're going to have healthcare facility inside of CVS. In the press this morning, Walgreens Boots, which we own, announced that they're going to be buying a chain of drugstores in China. So we start to see these companies diversifying their platforms and trying to figure it out in a web-based world. Other news stories? Okay. I want to look at specific companies. I'd also like to just sort of continue again with our report that we're going to do. Good thing for Christmas break. If we could have it done by mid-June, mid-January, so get a copy of it to me, to Professor Sy. We'll kind of wordsmith, we'll put the whole thing together, and then we'll go public with it. Okay, what I would first like to do is talk about, Tanner, talk about cybersecurity. Where are we? What do we want to do? What are we looking at? For the benefit of some of you who are just joining us, part of our process of deciding what we want to do is not just sort of picking stocks out of the air. Is we look for an underlying fundamental theme about what's taking place out there, and then figure out how we can participate in it. And there's no better issue than looking at cybersecurity, which we've been looking at really since the end of last semester, and I think maybe we're sort of like almost at the altar. Okay.
Yeah, so sort of like you said, with the data breaches continuing to rise, I was reading that by 2022, the industry is expected to grow from $138 billion to $232 billion. So I think we should definitely need to move on buying a company or two. And I think Raytheon is a really strong company because it offers both defense and they have a cybersecurity aspect that's been continuing to grow over the last 3 years. And I would imagine with everything that's been going on, they're going to grow a lot in the next couple of years as well. And I think looking at specific cybersecurity companies, I like Alibaba. I mean, they've had strong earnings, strong revenue. They serve in 150 countries compared to like a company like FireEye, which is only 67 countries. They have a larger customer base. This summer, actually, I read that FireEye had like an internal security breach, so it's kind of counterintuitive to what that company stands for. So I think Palo Alto is strong. Would be a strong investment for them.
There was an article recently, within the last couple of weeks, CalPERS, California retirement system for government employees in the state, said that one of the biggest issues that they believe in the coming years, from a perspective of corporate governance, is cybersecurity. And they're asking more of their investment managers, they're asking more of their vendors, they're asking more of their customers, like, what are you doing? So I wouldn't say that we're in the first inning of this, but I think that we're probably, maybe in the second or third inning of cybersecurity. And it looks like there's, paraphrasing, what your work that you've done over the last couple of months, like there's a lot of runway for it, for this, in this sector. So the question is, what horses do we ride? Why do you think that these are the two best companies in order to help us achieve our investment objective over the next, unfortunately, couple of years? And I say unfortunately because you guys will be going into the workforce, and as in the case of positions that we've owned for several years, you might not reap the benefit from it.
I think Raytheon, for one, is just a really strong company over the last 5 years. If you look back, they do a lot of work with the government, so they're guaranteed a lot of revenue. But on the opposite hand of that, if there's any budget changes, they could hurt a little bit. But over the last 5 years, they've posted really strong earnings, revenues, and growth. And I think they're going to continue to grow in cybersecurity, which will be a new aspect for revenue for them. So I think that's just a really strong investment on multiple levels. And then cybersecurity companies, I looked at...
Just back to Raytheon for a second, looking at their business, how much of it is defense and how much of it is cybersecurity?
Defense, they have a few different components of it, which are mainly around 20% for like 3 different things, but cybersecurity makes up a way smaller portion. I think it's around 5% now, but that's grown over the last 3 years. It's continued to rise.
Okay.
So I think it's definitely going to continue to rise with what's going on in today's world. So cybersecurity is a lot smaller portion of what they do, but I think it's going to keep rising like it has.
Okay. Palo Alto.
Yeah, so the main two things, they have like security products and then they have services like subscriptions. So the biggest thing is I think 45 or 50% of their revenue comes from the products that they sell. And then to the customers that they've sold the products, they sell them their services as well. So it's sort of like a 2-for-1 kind of thing to maintain those products. Over the last 8 quarters, they posted really strong earnings and revenue growth. They had a bit more cash flow compared to FireEye. I mean, FireEye is a newer company, or still growing rather, so I think that they're burning up a lot of cash and trying to figure out their operations. But they both went public Palo Alto went public in 2012.
Right. Raytheon's been around for a long time.
2013. So, but FireEye is actually down from their initial public offering price, I think like 20%, while Palo Alto has grown a lot. So I think it's just a stronger company.
Looking at, at the Bloomberg Wall Street analyst targets, and not that that is necessarily the answer, but you can look, firstly, in looking at Raytheon with the stock, closed yesterday around 183. Price targets range any from on the low side, 192 as high as about 212, which indicates, probably about potential. Again, these are Wall Street earnings estimates of analysts who are somewhat biased for a wide range of reasons, but generally positive, I would say, to the tune of, of plus 10 to 15%. In the case of Palo Alto, which closed yesterday at 142, again, similar story. Price targets range anywhere from, on the conservative side, 150 to as high as about 185 or so. So I would say, again, I think that, they're saying, analysts are saying there, 10 to 15% price appreciation is somewhat fair and reasonable. So, the question that we have to ask is number one, is this a growth industry? What sort of air pockets are they going to hit? If we assume for a second where, stocks keep hitting new highs, yesterday retraced a little bit, but stocks keep hitting new highs, how does this perform in an economy if we start to see, some sort of a slowdown or a contraction of GDP, or potentially those who are forecasting in 2019 a recession? How do you think these companies would react? Tim?
I think with the trend that things are following, how many things are moving towards more of a digital platform, from not social security, like individual, tracking, all your information, all your bank information, your credit card information, and with how skeptical people are becoming of the companies that they trust because of the Equifax of the world and every other company that's had a major scandal. I don't think cybersecurity is going to take much of a hit if the economy takes a hit, because it's almost a necessity now. It's a growing necessity. I think that other things like retail and some of the other things we discussed that are struggling would take a hit because those aren't really necessities. But I think for any major company, cybersecurity is a huge issue, and I think it's starting to become more of an issue for the average consumer on a personal basis. So I don't think it's going to go anywhere but up. And I like both these companies. Raytheon specifically, I think, is more of an investment in national defense. But I'm not sure that's a bad thing. Like 65, 66% of the business is from the U.S. government, but it's a relatively stable source of revenue for them. And with the recent scare, I guess you could call it a scare, North Korea showing that they have the power to reach any part of the United States with ballistic missiles, I think that, if anything, Raytheon's probably more valuable in the coming months, coming years than it would have been if that hadn't happened. So I don't think that's a bad investment. I think cybersecurity is an aspect of it that will probably grow, as Tanner said. But I also think that if we decided to go with 2 positions instead of 1, Alibaba would be the right choice.
Okay. Austin?
Yeah, I wanted to add on to what Tim said with, so we're looking at investing in a cybersecurity firm. We're going to take one that's a more diverse company and one that focuses more strictly on cybersecurity. And that's kind of what we did with our bank stocks as well last spring, where we did more of a diverse, well-rounded company and then one that took some loans primarily. And I like that idea, and especially with the current political situation in the United States. Trump's going to continue to buy up more defense things for the nation, so 7 years.
Other thoughts? Autumn? What do you think?
I agree with Austin.
Okay.
From like a defense side, like with how many contracts are going out now, I haven't heard I was using for what they're releasing contracts that go out. I've heard about like Northrop Grumman, General Dynamics, and other names, but I think like with them having cybersecurity as well as like defense, I think that's really good.
If I were to do my senior capstone on whether it's a company or whether it's an industry, my title would probably be, and think as I've said before, bad guys out there. Because that's not going to change. That's not going away. Wishful thinking to think that anything is going to happen on a positive side. So I think from a sector standpoint, it's a good place to be. If these are the right 2 companies, we'll find out. So question number 1 is, with our democratic process, general consensus, do we want to invest in cybersecurity? Show of hands? Okay, the yeas have it. The question number 2 is, what portion of our portfolio would we want to have in cybersecurity? Tanner, what do you think?
Yeah, I would say 5 in total, so maybe if we're doing Raytheon and Alibaba, and you say 3 or 2 or something like that. I think for 5, 6%.
Okay, so if we did 5%, would you do 2.5 and 2.5? Would you do 3 and 2? You just,
Probably 3 Raytheon, I think it's a little bit more.
okay. Do we want to buy a full position here? And again, with a $45,000 position for us, with a $900,000 portfolio, we're talking 20 in one and 25 in the other, just round numbers, we'll do the math. Do you want to do the whole thing now? Do you want to do part of it now, part of it in January? What are your thoughts, and what would motivate you to do either one?
Personally, I'd like to pull the trigger on both.
Okay.
I think we've been monitoring both companies for like 3 or 4 months now.
Mhm.
I've been talking to Tanner about it. I've been itching to get a position in Raytheon, especially with also Palo Alto after doing a little more research.
Okay.
And I think he feels the same way. He's done a lot more extensive research than I have. As you know, he's been on top of cybersecurity, so I'm comfortable doing both. I think our portfolio is doing really well, and I don't see that these companies would pose a problem for us at all. I think it'd probably be pretty beneficial.
Okay.
I think the industry is growing pretty fast, and pull the trigger now and see benefits.
Okay. Other comments? Gabby, you go?
I honestly agree with everything that's been said, because it really is, like you said, like the bad guys are out there, but they're not going to go anywhere. There's always going to be outside threats, and cybersecurity, with just digital media and data, is just going to become bigger and bigger. So I feel like cybersecurity is definitely.
Okay. Anyone else have any other thoughts or comments? Yes.
Okay. So if you agree to purchase these 2 holdings, where do the resources come from? You have to decide to sell something, or are you just working with your money market?
No, we have about $54,000 in cash. Okay. We have again, the market value of the revenue is at $900,000. As Tim referred to, Tim and Tanner, a 5% position, 5% is $45,000. So we have cash. So that's not an issue. And again, we'll do a 60/40. Thoughts, comments? All those in favor? Okay, we'll do that. Part of our research process is obviously reading stuff online, whatever sources and whatnot. But I think that in recent history, and I would say that is the last 6 months or so, I would commend Trey for a question that he asked maybe 6 months ago, and he said to me, "Do you know the company Polaris?" And I said to him, "Well, I've heard of it, okay, but I really don't know anything about it." And so Shreyas's thesis was, driving up and down the New Jersey Turnpike, there are several Polaris buildings. Why don't you take it from the top? Why we ended up buying Polaris?
So I just haven't noticed that over the time when I drove up the turnpike to New York, I saw Beware and they had a production name on them. And that sort of got me thinking about what they were doing. And so I went online and I found an article that was talking about how the turnpike was booming because there's a lot of the warehouse companies wanting to get locations there so they can see items basically on the East Coast. And so what's happening is as sort of retail stores and stuff a lot of the companies are trying to take all the warehouses, create a longer turnpike, bigger transportation easy, and they're receiving a lot of expenses in the area. And so I just want to get that from talking about it, just to make sure they're really. And so he also noticed that there are a lot of warehouses, so the better company is the biggest company in the industry, and so we thought it was a good idea.
And interestingly, my weekly trip on the turnpike, there are more prolonging equipment that are under construction. So obviously, if you want to participate in the demise of retail bricks and mortar, or participate in Amazon, which we happen to own already, let's buy the intermediary. And their largest tenant is Amazon, but only 3% of their business, it's a significant portion of their business. It's not until 50 or 60% customers. So we have that position. Okay. I'd like to talk about Alibaba. We started this conversation about a month or so ago. There may or may not be an opportunity with Alibaba, but let's kind of do a deep dive on it. Who'd like to get the ball rolling? Tim.
Obviously, this past week I didn't follow as much, but previous week I don't really get a chance to talk about it. And I was looking at it a little bit back then. Obviously, just explosive growth sort of imitates that of Amazon. And it's a company that has a lot of things in common. It's not a U.S. company, which is a little bit different, but I don't think that's an issue at all. And if you look at the growth, it's pretty much on pace with what Amazon was when it started out. So I think it's going to continue to grow. I think that it provides a similar service. And I mean, in its home country, it's pretty much the same thing. So I don't think it would be a bad investment at all. And I don't think it's shown any major red flags for us as investors.
Other thoughts? Looking at the two companies, firstly, Alibaba selling at a more reasonable, if you call it reasonable, 34 times earnings. Company has a market cap of $432 billion. And again, considering the history of the company, less than 10 years old, very impressive. Looking at Amazon, selling at 270 times earnings, I would call that a high-octane company. but clearly Amazon is the model and the industry standard with a $550 billion market cap today. How are the two companies different? What's the difference between the companies, Austin?
I wanted to ask a question. So I don't know much about Alibaba, and I don't know if this is true or not, but I read that it's Alibaba's kind of like Uber and Airbnb, where they don't have like they don't have physical assets or anything. Isn't it just like an online kind of?
Does Amazon have physical assets? Yeah, it's another Amazon. It's I would say the Chinese version
And they
of,
do clothing retail.
I'm sorry?
What is Alibaba doing? Clothing retail.
Everything. There are, Shresh, do you want to
So they have like
add? What is Alibaba?
I think the concern is their their website is designed very similar to the way Amazon is, and they sort of offer like the same range of products that Amazon does.
Yes.
Just to add to this, the reason the couple was when we started talking to Alibaba the first week, really soon with them, back on like November 11th, like one is the day that they have like their biggest, it's like their biggest, I think, online like sales of the year. And this year, the numbers just went like more than like double what they had last year. And like, that's the whole reason we started on.
Right. And in comparison to Amazon with Black Friday, whole shopping weekend, and Cyber Monday, Singles Day is bigger than those 4 days. And Jojo, give us some commentary. Yeah.
I also want to add something about Alibaba. The difference between Amazon and Alibaba is that Alibaba also owns a financial services company, and it's practice. A financial service group is the largest like mobile payment in the world, and Alibaba like also owns insurance company and entertainment business.
Okay.
And it's last year it bought like many insurance companies in the world, and
Is that good?
yeah. I think it shows the level of the insurance in China, like the online insurance. Like,
So in the U.S., if I wanted to buy an insurance company, and I wouldn't buy Alibaba, I'd buy MetLife or Northern
no,
Insurance.
like Alibaba bought some other insurance companies.
Okay.
What
What do you think the reason would be why you want to buy Alibaba, or maybe not buy it?
Like in China, it's like have no like online selling, and also it's very well like you get the data from the
Other thoughts? I would say for me, the reason that I would want to consider it, not necessarily buy it, I want to consider it, is what's the population of the U.S.? 330 million. Population of China. And they were Indian. Okay? So, Asia dwarfs Amazon. And so I would think, again, just on a basis of relative value, comparing 280 times earnings versus 30 or 35 times earnings, gee, something's either too expensive or something's too cheap. Well, this is what the market says. This is where these things are priced. I would be interested in continuing to explore Alibaba because of the growth geographically of the people in that region. In terms of similarities between the companies, Alibaba has moved into digital. Alibaba has moved into the cloud. Happens to be a small portion of their business, but again, when we're dealing with a population of about, 1.2 billion people, it seems like there's a tremendous amount of growth that is possible. Yes.
Is it a good time to change topics?
No, I just want to sort of finish. Any other thoughts on Alibaba? Is it something that fits in the portfolio? Yeah, Ken.
I was gonna, you touched on it, but, the population there is so much larger,
Right.
and the stock is, so much cheaper that I think it would be an investment to look at. I think that, in terms of fitting into our portfolio, e-commerce is something that, we already have a position in. I think Alibaba, doesn't necessarily compete because of its geographical locations, headquarters. I don't think it really competes with Amazon, in a way that's gonna affect it negatively. I think that it's sort of in a different market segment right now, and it's performing in a way that mimics Amazon in the US. So I think that the growth that it's experiencing is probably going to continue, maybe not at such an explosive rate, but I don't think it's probably going to take a huge fall or anything anytime soon. I think that it's established itself as the number one e-commerce provider in that part of the world. So personally, I think it would be a good investment after looking at it this past month. I don't think it would be a bad time to get a position in it, but I think also if we're looking at getting a pretty sizable position in cybersecurity right now, that we might hold off on this for a little bit.
Okay.
Continue to monitor it, because I think, like you said, some of that growth is driven by the whole, I guess, like aura of Singles Day. A lot of people probably just absolutely shoveled money into that company on that day, so I think we're going to keep looking at it until we get back to break.
Other thoughts? Yes.
I completely agree with him, and if anything, I think Alibaba sort of has an advantage over Amazon in terms of international market, just because they make a lot of cheaper products. I think consumers are more likely to shop there, and I don't think the Chinese market is going to look at Amazon at all, or any of the Asian markets. But I think there's still a lot of room to grow, especially with both India and China, where economies are rapidly growing.
Yeah.
We always talk about keeping our portfolio diverse and diversifying in different ways.
Right.
And how many companies do we have that is primarily market is overseas? So I think it's something we look at.
And it's the fastest growing area
Yeah.
in the world. Yes.
Like Tim said, it's another company we have in the e-commerce section. We're betting on stuff like cybersecurity, e-commerce, because we think brick and mortar stuff is going to die. So I think it would be good to have a little bit more of our portfolio looking towards the future and what's going to happen. Because I think we've already been doing that in other areas, so why not expand it into e-commerce a little bit more? I think it'd be good to have over 4% of our portfolio and stuff like that.
Any other thoughts? All right, let me weigh on this. I think these are all great ideas. I do think that the diversification into more e-commerce is diversification into a part of the world where we don't have direct exposure. And in terms of making a market bet at this point, hopefully we continue to rally in here. I don't know. What I'd like to do is I'd like to table this discussion until January. Let's continue to think about it. I'd like to build a model, so to speak, if we can, looking at Amazon and looking at Alibaba and look at the different product lines that they have, the different segments of revenue, where it comes from, as a basis of comparison. Obviously, we know online shopping. It sounds like financial services is a significant chunk of Alibaba. That's not the business model for Amazon. Video is in both places. Cloud computing is in both places. Let's put the two next to each other and see how we think that shapes out for us. So again, we'll huddle up in January, and the second part of that will be is, since we don't have cash, what will be our potential sale candidates in the portfolio to make room for position in Alibaba, if that's something we want to do, or any other sale candidates that we might use as a source of raising capital to add any other positions, or just get defensive if that's what we'd like to do. Any other questions, thoughts, or otherwise? Okay. What I would like to do is introduce Josh Humphreys very briefly. I'm going to have Susan say a couple words for a basis of comparison for what we're going to talk about. Just real quickly, and I'm not going to read Josh's bio. I'm going to let you do that. I've known Josh for about 10 years now, when we met at the TELUS Institute. Josh started the Croton Institute, which is based in North Carolina. Josh is a real thought leader in the area of ESG, SRI, sustainability, all the good things that we talk about, and hopefully the direction that investors want to move in the future. And certainly for us it's important because it's the intersection of what we're doing here in investing, and if I can call it, best practices of investments that incorporates the issues of sustainability. Susan?
I just wanted to say a few words on behalf of Professor Meyer out yonder. He's the director of the Sustainable Finance Initiative, and they are a co-sponsor of this event, so we're really excited that we've got both. And I know we have students who are in both ground advisory and also in the Sustainable Finance program. And so having Josh here is just a fantastic way for us to see how these two things intersect. So just for those of you who are aware of the Sustainable Finance Initiative, it's something that is supported by the Pew Trust. We have a grant from the Pew Trust Foundation, and the idea is that we want to expose students to methodologies, ideas, and insights about finance from different disciplines. So they're looking at different ways of thinking about finance, and the idea is that we want to look at ethical, economic, historical, a lot of different perspectives of finance. And so sustainable, thinking about sustainable, and how all these things intersect is a great way for us to have a co-sponsorship. So on behalf of Professor Meyer, the Sustainable Finance Initiative, we also welcome Mr. Humphreys.
Well, thanks very much, Richard, for having me back. I've had the pleasure of either via Skype or coming here to Chestertown to speak to the Brown Advisory Group. And it's always a pleasure to speak with student-run funds because I see it as a really interesting experiment. And I also serve on the advisory board of the Dwight Hall SRI Fund at Yale, which is one of the earliest student-run funds that's really focused on sustainability. And obviously there are a lot of others around the country now. So I'm always happy to come and talk about the insights that we're learning about this space. I wanted to begin with a somewhat uncharacteristic question, and as I was thinking about what I might talk about, since I've spoken to this group before, and I think I spoke recently in the spring, if I recall. I don't know if any of you folks were here in the spring when I came. So I wanted to switch it up a little bit and just begin with a simple question about whether anybody in the room has student loans. Anybody got student loans? By a show of hands. Don't be bashful, I've got them. Yeah, I'd say a good 60% of folks in the room have student loans. Anybody know how much student loan debt there is out in the U.S. economy today? A lot. Can you give me a number? No clue. Anybody want to hazard a guess? Millions? Billions? Trillions? 35 million? Billion. 35 billion. It's a good guess. It's like that maybe a decade ago. It's over 1.2 trillion in outstanding student loan debt. 1.2 trillion. Now, student loans become big in the T for trillions because of investment in student loans. So what's fascinating is you guys are always talking about picking stocks, figure out what goes into your portfolio. Well, some folks are doing the same kind of analysis around student debt, whether your loans are good investments. And I think it's kind of an interesting proposition because on one hand, we want to invest in education. Maybe that's one way to get exposure to education. Education is sort of, an eternal trend, right? And in fact, the growth in student loan debt has been linear. When we saw the financial crisis, mortgage debt collapsed, basically. Lots of homes got foreclosed. So you saw the same ballooning of housing mortgages suddenly crater We also saw it with auto loans, credit cards. There was just a mass deleveraging of the economy, but not the student debt space. Student debt's just kept on going up. So for many people, many investors, they see it as an interesting investment proposition, remarkably stable linear growth. The interesting thing is to get exposure to your student loan, how does an investor do it? How can an investor actually invest in your student loan? Anybody have a sense of how you might get exposure to the loan that you carry right now, or that in fact I carry? Yeah.
So like I have mine through like Discover, but then other people buy it from Discover. So like Sally Mae, like people like that, like Sally Mae is really payment, but I know like a lot of companies just buy it.
Right. So we're getting there, yeah. Discover is a credit card company, and they do private student loans and other things like that. Sally Mae used to be a government entity, government-sponsored enterprise is what we called it. Sally Mae was for student loans what Fannie Mae, Freddie Mac was for housing loans. Government-sponsored entity that basically provided subsidized capital to fuel what was presumed to be a public good, housing, education. But in order to provide people with houses and to provide people with education, it seems like a lot of people who benefit from that basic public good have to go into a lot of debt to get access to that asset. So it's definitely something that gets sold then. But the curious thing is, how does someone sell one of your loans? I mean, what's the investment vehicle for that? Because that's definitely what's happening. There's sort of buying and selling of these things to different companies. Any clues or insights into how you might do that? It's actually very similar to how you would buy mortgage debt, for people's home mortgages. Yeah. Yes. Yeah, you bundle them together because nobody wants to buy your loan because they don't want to take the risk in you because you're way too risky. All of you guys, way too risky. But if we put together a bunch of student loans that have different characteristics, you're the characteristic. You are basically the fundamental investment criteria. And it's hard to understand the risks that you actually pose to an investment portfolio. Are you going to get a job? You're going to be able to pay off this loan? What kind of job are you going to get? What kind of terms do you have for your loan? Are you going to have to, right out of college, maybe you don't get the job you want, maybe you're going to have to ask for a deferment. That means you don't start paying off the loan when it's actually due. For an investor, that's troubling. You didn't get the job you want, then suddenly I'm not getting paid. And packaging together lots of student loans presumably mitigates that risk, right? Because maybe you're not going to pay off your loan. But hopefully the other, 85% of you will start, won't have to go into deferment. This is the basic fundamental proposition. What's interesting is that you've got a $1.2 trillion market around student debt that's investable. And it is indeed packaged together into asset-backed securities. So instead of buying an equity position, in a company, a stock, you're buying a debt security. And a lot of this stuff is tradable on the fixed income side. And I don't think you guys are doing any fixed income work, right? Richard, it's all equities. But this is Richard's old world, right? Bond trading, extremely complex. And the bond markets actually are larger, as we've already seen, than the equity markets. So what you're doing here at the Brown Advisory, investment fund is really just a very, very, very small sliver of the capital markets. And it's really one thing that I wanted to impress upon you, when you start thinking about long-term investing, start thinking about sustainability. There are lots of ways of getting exposure to different kinds of trends. But some of these trends, which purportedly seem to be a public good, like housing, like education, actually have some pretty perverse effects, right? Because suddenly if you go into deferment, you don't get the job you want, you don't have the salary that you're needing to repay that loan, you may have to extend the terms of the loan, turn it into a 30-year mortgage, which is really not what a student loan is supposed to be. It's supposed to be paid off much more rapidly. ultimately, you've got investors who are eager for you to be a responsible citizen. But we also live in an economy that doesn't always allow us to do that. And I think that's the kind of fundamental proposition behind the work that we do in the sustainable investing space. Is try to understand these other forms of risks and these other forms of trends that may be deeply material to investing, but that you may not immediately think about, precisely because of the issues that were described before. Issues of ethics, issues of long-term sustainability, major trends like global warming and climate change that may not present itself in the portfolio today, but inescapably is going to manifest itself by the year 2050. And 2050 may seem like a long time from now, but it really depends on your investment position, right? You're going to be well into your careers in 2050. You're not even going to be touching your retirement assets by 2050. But climate change is going to manifest itself in all kinds of interesting ways, pretty deleterious ways generally in portfolios. The endowment of Washington College, to which you're going to be wedded for the rest of your life if you graduate from here, because folks from the development office are going to be asking you for gifts in the same way that they've asked my family for gifts since my grandmother went here, class of 39. And that's precisely because the endowment helps to mitigate some of this risk, right? In theory, the endowment should be used to avoid having you guys go into debt. But that's not always the case if the endowment's not strong enough. And the endowment is an investment vehicle too. And the endowment at Washington College is almost as old as the history of the United States, right? And there are some endowments, the model endowments for institutional investment, Harvard, Yale, Dartmouth, they actually have a perpetual investment horizon that's older than the history of the United States, because these are colonial institutions. So their investment horizon is extremely long-term. And what's interesting is that the star chief investment officer of Yale University, David Swinson, has developed a model for institutional investment that takes full advantage of that long-term investment horizon and asks this fundamental premise, if I'm a long-term investor, what can I do? What can I do that you guys can't do, frankly, here? Because you're just running a fund over a relatively short-term time horizon. But if you're a college endowment with a perpetual investment horizon, you have a completely different view of risk and opportunity. And on one hand, that's intriguing. And indeed, Mohammed El-Arian, who ran the Harvard Endowment for a while after being at the largest bond fund company in the country, PIMCO, people asked him, why in the world, Mohammed, would you want to come run the Harvard Endowment after being at PIMCO? PIMCO dwarfs the Harvard Endowment. At the time, it was only about a $30 billion fund, whereas PIMCO was a $1 trillion bond fund manager. And he said, precisely for this reason, is that at PIMCO, we're trading every day. We've got a lot of clients who have short-term needs. To go into an endowment where I can have a long-term investment horizon, it's a completely different game. Now, interestingly, when he was asked this question, he also said another thing. He said, also, it's a tax-exempt endowment. It's a nonprofit. So that means I can issue tax-exempt debt into the capital markets to fund our operations so I don't have to spend my endowment. Interestingly, that's illegal. You can't do that. You can't issue a bond from a university in order to tap low-interest, tax-exempt debt in order not to spend the endowment so that you can avoid having your students go into student debt. So these things are actually intimately related, right? That's called arbitrage, called tax arbitrage. You can't do it. And this is precisely why in the current legislation, the current tax bill, endowments are now suddenly being presented with an excise tax because they've been playing these kinds of games, curiously. And I want to suggest that, again, it goes back to basic issues of ethics, that there's opportunity in investment in every asset class, in every geography. The question is, are you going to seize every opportunity? Are you going to be an investor in the burden of student debt for future generations because it's a $1.2 trillion market that has linear growth? Or are you going to exercise some kind of moral scruple and say that perhaps I don't want to participate in the securitization of student debt? And what's interesting is if you actually look under the hood, you'll find that everybody's doing kind of a sloppy job in finance because everybody wants to make money. That's why you go into finance. But if you look under the hood, the credit rating agencies that are actually monitoring Sallie Mae, which you mentioned. Actually, Sallie Mae has been privatized since it was a government-sponsored entity. It's been turned into a publicly traded company. It's called Navient. You guys might want to take a look at it. I don't recommend it as an investment, but it's an interesting publicly traded company to look at. Navient basically services a lot of these student loans. Largest student loan servicer around. It's exactly the group that bundles together mortgages into those securities. And what they do is create a whole series of trusts to package together these student loan ABS, asset-backed securities, slabs, that's what we call them. They're akin to mortgage-backed securities, MBS, that basically package together a whole variety of mortgages together so that they could be turned into an investment security that you could invest in. And of course, you've got all the different loan tranches within that of a variety of different kinds of quality. And in the housing market, we have a very rigorous system for determining the credit quality of the mortgages. In the student loan space, we don't at all. Because there's an implicit government guarantee behind so many student loans. And in fact, if you were to go bankrupt, some of you will go bankrupt. You may not realize it, but some of you will go bankrupt. And what that means is just a legal proceeding. It just means I don't want to pay my debt anymore. That's what you're saying. Our president has done it multiple times with his companies. You do it because you don't want to pay off your debt. Doesn't mean you can't pay the debt. You're just saying, I want a clean slate. That's what bankruptcy is. It's not any kind of moral condition. It's a purely legal condition that you choose to just completely get rid of your debt. Now, when you do that, that's problematic, right? If someone's invested in a loan that you now are suddenly just completely discharging. Student loans, unlike housing mortgages, they can't be discharged in bankruptcy, at least not easily. You have to pay back the student loans unless you really have a serious case to be made. It's very, very complicated. Because there's nothing to foreclose, right? What are we going to do? Take your diploma away? You know, there's no collateral. You've put nothing down for your student loan, right? Nothing. No one's checked your FICO score to give you a student loan. Maybe some of the private loans your parents are co-signed on, perhaps. But overall, there's no credit analysis. So how can we tell all the different loans that you guys have put into these securities, or that they put your loan into their securities? How do we know the credit quality? With housing, we know a subprime borrower, we know their FICO score. We're going to have a higher interest rate for these people to manage the risk. Student loans, not at all. We don't have an understanding at all. The interesting thing that's going on with student loans, even as you see linear growth, macro trend, everybody's going to keep going to school, going to continue to rely on debt, because colleges aren't cutting tuition costs for some reason. Colleges have been increasing tuition right over the last 2 decades at a pace 5 to 8% above the rate of inflation. Even our nonprofits, 5 to 8%. This is why we do student loans, right? Because we can't afford the sticker price of college, even though we feel the impetus to create a degree, or seek a degree. So what's interesting is that if you look at the bond rating firms, we're looking at Navient in order to assess whether this is a good investment. They actually don't look at the structure of the complex financial security that's created. And I don't know, Richard, how much you guys talk about derivatives in here, but that's what this is all about, right? Derivative finance is the biggest part of the bond markets. Derivatives are hilarious or what?
Yeah, now we're in a class right now with Professor Stein.
Yeah, working on derivatives.
It's a funny class.
They're a ball. It's just blast, right?
Yeah.
Absolutely. Well, a lot of them are crap, right? You know what a flip clause is? How does the flip clause work in an ABS?
We haven't gotten there yet.
Not gotten there yet. Oh, man, oh, man. Man, oh, man. Yeah. Yeah. Well, what else is hilarious about a derivative? You like them when they blow up? You like them when they do well? How do you structure them? Usually you got to be a theoretical physicist to figure out the model. Is that your Doing physics?
No, it's not my expertise.
Yeah, yeah. Anyway, I mean, I think this is the basic issue, right? Is like, do you have the patience to really figure out how these things work? Anybody see The Big Short or read The Big Short? Yeah? For the class?
No, I actually was talking to Professor Sai that she should watch the movie.
Okay. Those guys in The Big Short, you know, Professor Michael Lewis's book, they spent the time to actually read the offering memos and actually do their own risk because they didn't trust the credit rating agencies, basically. The flip clause, you know, uncleared flip clauses. What that means is you got counterparties in any deal structuring this, basically. You've got somebody that you're working with, whether you trust them or not. There's not a lot of trust. That's when we get into Bitcoin, blockchain, all this kind of stuff. No trust, but we still need transparency. Basic asset-backed security. You've got a structure, and basically, someone is a counterparty on all this risk. If somebody defaults, the flip clause flips the position of seniority, okay? That is, who's really exposed to the default? Who's going down? Who's losing money on this deal, basically? That's the fundamental question. The flip clause that structures any derivative contract within asset-backed securities is not part of the Moody's credit rating. The credit rating is actually not for the trust of Navient that's issuing that particular slab. It is only for Navient itself. Now, the interesting thing is when you start getting into exactly who pays whom, who's investing in what, you find basically a lot of interesting systemic risk in the capital markets because ultimately it takes one default, you know, Lehman Brothers during the financial crisis, who's on the bond side, had exposure to a lot of this stuff. And in fact, they haven't even resolved, you know, a decade after the financial crisis, how these flip clauses actually function in legal terms. I mean, the Lehman case is still up for appeal about the nature of the flip clause. And yet, here we are. We just continue to churn out these derivative contracts, produce this stuff. If you've watched The Big Short or similar kinds of Wolf of Wall Street, you see how these things get done. Las Vegas hedge fund conferences, you know, all this kind of stuff. I mean, this is real. This is real. This is real life, right? Marketing budgets, Lehman Brothers went to prostitutes and cocaine for their traders to get this stuff done. All right? This is real social life of finance. When we kind of have a fundamental purpose of finance. Like, what's the fundamental social purpose of finance? Give you guys an education. People are investing in you. Not only your parents and your friends and people who are going to come to your graduation, but Deutsche Bank, Navient, a lot of people are banking on you to get out, graduate, do well, pay your loans back. So we're in a pretty paradoxical space these days. Politics, crazy. People expect you just to keep on paying these 5 to 8% inflationary tuition rates. Your kids, grandkids, you got to do the numbers, right? Like, not only do you have to save for your retirement, I've got a 8-year-old daughter. I did the math when she was born to create a college savings account. We stay on trend, 5 to 8%. Cost of college for her when she's 18, 4-year education, private education, full sticker price, we're touching $1 million for 4 years. Unless the trend peels off. But you guys are going to do all right, right? You're going to be able to pay the $1 million tuition for your daughters in the future? Or are you going to ask your college, maybe could we bend the curve down, stop charging 5 to 8% annual increases in tuition? Because education is a social good. And we shouldn't have $1.2 trillion in student loans to fuel education because it is a public good. Like, how do we bend these kinds of curves? Well, the interesting thing is that you can also use capital, not just to structure and package crap and try to sell it to the next sucker who's behind you. You actually can go back to the fundamental purpose of finance, which is actually embedded in the very terms that we throw around, the jargon of finance. Bonds. Bonds are what connect us, right? It's not just about a tax arbitrage strategy in order not to spend down your endowment so you can have cheap debt on the books of your Ivy League college, right? It's a social compact. I mean, get into political philosophy, not just ethics, right? You go back to Jean-Jacques Rousseau, right? That also is a contract. It's called a social contract, right? About the general will. These are revolutionary ideas at the same time that this college was founded. We're still debating what it means to have bonds with people. What's the nature of social life? How does that translate into political life? How do the bonds that tie us together? And I'm a French historian by training, actually. So what the French revolutionaries did with a Rousseauian political philosophy was actually banned associations, banned guilds. Those were the old regime, right? That was feudal society, seigneurial capitalism, mercantilism. Were structured by precursors to trade unions, guilds, artisans who are protecting their labor by joining together in associations. And democracy, revolutionary democracy, and then the French Republican guys said, no, we want egalitarian citizens. We want everybody to be equal. And the guilds, just like the bosses coming together, the lords, these things are getting in the way. They're kind of dividing up our society in a way that made it difficult for people to move where they wanted to move, to get an education and pursue the career that they wanted to do, to express themselves as the individual that they were. And this was a basic Enlightenment proposition. So let's tear up civil society. Let's revolutionarily overturn the existing order. And we use politics to do that. And it's kind of an interesting proposition, like you've got to kind of break the back of the seigneurial order. The lords, get rid of serfdom, get rid of the guilds, get rid of small associations, so that everybody can just be equal. We can have transparency in civic order and civic life. Radical transparency so that we're all on an equal playing field. Let's start over. It took a century into the 19th century, the late 19th century, for the French to do basically in a different way in the US we always kind of did, which is to valorize association. Not trade unions per se, but just voluntary associations, right? Alexis de Tocqueville, the French aristocrat, democratic historian, came here in the 1840s and highlighted, where in other places government does activities. In the US, the young United States, we find a voluntary association of men doing it. And he said men, because women were excluded from a lot of political and public life in the US. And this is 1840s when we still had slavery. But he valorized that premise that if people could come together and associate freely, they actually learn to govern themselves. And that then translated into actually the explosion of capitalism in the late 19th century, because suddenly realized, okay, we actually can create associations. We can have labor unions. We can have voluntary groups. We can create corporations with limited liability so that we can come together and not bear the risk of creating enterprise all on our own shoulders. And we can spread that risk over the whole of society, really. That the liability for creating new enterprises is something that we should all share. Because it's also a public good to create business, right? To grow the economy, to get things done together, to join in associations, members, literally. If you create an LLC, which is what a lot of people are going to be doing with the new tax bill, right? Everyone's going to be creating LLCs, limited liability corporations. These are pass-through companies because you get lower tax rate in the new tax bill by creating pass-through companies. You're not going to be the plumber just going out. Remember Joe the plumber? Well, you guys probably don't, you're too young. But the self-employed plumber that doesn't have a corporation attached to him, he can't write off any of his expenses anymore. He's going to be taxed on his gross income in the same way that a self-employed consultant is. So he's going to have to create a company. He's going to have to find members. He may be able to be in a jurisdiction where he can do it himself. It's going to be hard to invest in that guy. And I think that's really the interesting moment in which we find ourselves, is that we can, as investors, as future investors, that's sort of what you are. I come from the agrarian South, so we used to call it future farmers of America. That's big on the Eastern Shore. You guys are the future investors of America. And it's serious. It's no joke, right? I mean, this is no joke. Equity, the word equity, we associate with ownership. And also, it's a word that means fairness. That's like, good sportsmanship, right? This is why at the university we have teams, right? This is why we compete. We compete on a fair, level playing field. So, Rich, I'm doing something a little different than I usually do, because I can talk about big picture trends, but I've talked about it to this group before. I think we're in a particular moment where we really need to find our moral compass. For all of you folks who are going to go into finance, because if you don't, you're going to be tempted to go to the Las Vegas hedge fund conferences. You're going to take full advantage of your marketing budget, and you're going to be looking to basically crap on somebody in order to make a buck, or make your bonus, buy your boat. But finance is really important, you know? It's extremely, extremely important. And what I'm excited about, I just got back from a hedge fund conference in New York last week called the High Water Women Conference, where a group of women in finance are saying, "Me too finance," right? Like, folks are sick of it. They're really, really sick of it at this point. And the fact of the matter is, if you have a more diverse board that includes people of color and women, McKinsey's done the study, performs better than the ones that are run by white guys. Because you guys just want to run stuff in the ground, rip, strip, flip. That's the way it's happened in the past, and laugh all the way to the bank. It's not happening anymore. Your companies are underperforming. You got to have diverse companies. You got global markets. You heard about Alibaba. Like, can we invest in China? I'm not really sure. I don't get it. It's kind of funny. Like, it's global. The world is diverse. We're just 300 million people here in the US. The white majority is not going to be here for much longer. Get used to it. Climate change is coming. Hurricane Sandy's already shown it to us. Well, the cover of Bloomberg Business Week. I mean, folks in finance who really look into this stuff, they get it. And they look under the Moody's credit rating and they see that student loans are toxic, because you guys are not going to be able to pay this stuff off. Because that's exactly what's happening. The credit quality of those slabs, they're deteriorating, and yet the Moody's rating, no downgrades. Just like in the housing crisis. So it's like a ticking time bomb. And yet at the same time, there's all this crap in the capital markets that you can invest in and maybe make a short-term buck, especially if you use some tax arbitrage, if you're an endowment, on the sly. Or go offshore, which is what the Paradise Papers, Panama Papers have all shown. We've done it in our research. We've been working on endowments. Journalists have been surprised. Why is the Harvard endowment in all this offshore stuff? Why are they going to tax havens if they're tax exempt? Doesn't make any sense. Well, it's because they're investing things that have nothing to do with the mission of the nonprofit. So sure, they're going to be taxed when they go offshore. And Richard's a hedge fund expert, so he knows exactly why you do these kinds of things. But there becomes a kind of fundamental question if you're a nonprofit investor. It seems to me, if you're a faith-based institution investor, why do you go offshore just to avoid the unrelated business income tax? Why do you do that? It's because you're not in the Cayman Islands to do a mission or development project, right? You're just buying a post office in Georgetown, in Grand Cayman. But the question is, could we be doing better development in the Caribbean by actually directly investing? And that's what the opportunity for sustainable investing is. And there's a growing group of impact investors who care a lot about this stuff and are finding interesting ways to make money without hurting other people. And I think that's the fundamental premise. And the opportunity in finance is to go back to the fundamental purpose of finance. It's not the 80s. That wasn't the fundamental purpose of finance, as fun as the movies might be. The fundamental purpose of finance is to go back to those etymological roots of what finance is all about. Or enterprise. The very language of enterprise is rooted in these concepts of social bonds, connections that tie us together, joining together in association, get stuff done that you can't do by yourself. It's actually kind of a socialist premise. Proudhonian socialism, what they call it in France. It's like coming together, you can do more than by yourself. Now, that's not communism, but in the 19th century, all this stuff was like crazy. You didn't really know what this was all about. There are a lot of different forms of association. But ultimately, whether you're artisans or you're entrepreneurs, it's still about building something. And hopefully something that's useful to other people. That's why we have these things, right? Somebody created them. We're using them like crazy. We're always in them. I'm glad nobody's looking at their phone right this second, which is actually kind of unusual these days. So I appreciate that, actually. But these things are revolutionary. Revolutionary for our politics, too. And it's great that we have a legal framework that allows people to take that risk. Entreprendre, right? That's what the French word is, to sort of take it on, to do that. But keep in mind that equity is not just about these stocks that are bouncing around in the Bloomberg terminal. Equity is about fairness and justice, to do a just deal, to create a just transition from, a past that's rooted in fossil fuels to the opportunities associated with the renewable energy future. And you might lose some money if you go in a little bit on that Solar City security, the bonds of that. I wouldn't recommend that. But you want to get exposure to this, because climate change has difficult, deleterious impacts, but it also presents amazing opportunities to invest in a clean energy future. So I think I'm going to stop there, Richard, because I've taken up a bit of time, and I haven't given you a lot of the quant stuff, but hopefully it's okay. But I'm glad to take some questions or have people push back on some of these remarks. But I think I don't often get the chance to opine more philosophically on the fundamental purpose of finance. But I think that's really what, ultimately, if we're going to push you, jokes aside, that's why you're here, right? You're trying to get an education, right, about this. You're trying to figure out how the capital markets work because you want to have a good future for yourself, for your family, for your friends. And there's a lot of fun to be had in that. Impact investors have fun. I go to the parties. They're good. We don't have prostitutes and cocaine. And you can still have fun. But thanks very much for letting me be here today, Richard.
Question.
Yeah, I don't know who wants to, should I moderate this too, Richard? Yeah, go ahead. I'll try to take as many questions as I can.
So what do you think the solution is to the student debt problem rising? How do you think that you stop the 5 to 8% growth?
Yeah, so, it's interesting. I have a PhD, right? So I was in grad school, and one thing that came out of the tax plan was this idea of taxing tuition waivers. I don't know, did anybody see that? Kind of popped up real quick. It's been kind of crazy, all the stuff in the tax bill. So the idea, grad students, and Washington College is just a liberal arts college, you don't have a grad school, so you don't have this dynamic with TAs and everything. But, at a lot of larger schools, you've got graduate students who are TAs or research assistants. So they often, if they're good, based on merit, they often don't have to pay tuition. Undergrads, you guys are paying for the grad students at big colleges. So they get a waiver for the tuition. It means you don't have to pay it. There's been an exception for that. It's not treated as income, although that's a gift, right? You're basically not having to pay, you tell me what the number is, $30,000? That's out of state at Auburn or whatever. $50,000 MIT. $50,000, you get that gift every year, free tuition waiver. So the tax bill, at least in the House version, said we're going to tax that. So, the stipend that a grad student gets is kind of laughable, right? When I was at NYU, it started at $12K. We created a graduate student union and went up to $18K. You have to live on $18,000 in New York City. I don't recommend it. This is in the 90s, a little easier. But, so you're making $18,000, but suddenly you've got to pay tax on that full freight, 18 plus 50, you do the number, $78,000, suddenly taxed at a middle class tax rate, upper middle class tax rate, even though you only get $18,000 of income. So suddenly, you're paying astronomical taxes. That threat suddenly heralded a thing that the academic professions have never been able to do, which is stop the glut of PhDs. There are too many people going to grad school who don't have job propositions. This is the reality, right? This is part of the student debt crisis, is that, I can't get that job I want. I'll go to grad school and extend this mother out and take on more student debt unless I can get one of these sweetheart deals in academia, PhD, tuition waiver. I think that's the problem that we have right now, and that suddenly grad students are protesting the tax reform bill. It's like, protest your administration, tell them to just cut tuition and stop doing the fake accounting. Because all those tuition waivers are being booked as income by the schools on their balance sheets. And I don't know, is the chief investment officer of the college here? Because I'm saying a lot of bad stuff about colleges, but in terms of the higher ed finance. But that higher ed finance is, it's crazy. So you guys have to, you have student government, right? You have to say, stop doing this. And, I know Sheila Bair, to her credit, former president, made this a huge priority. Student loans and college affordability. And some of you may be beneficiaries of some of the programs that she put into place when she was here. That's what needs to happen. And Sheila, to her credit, I know she's gone, but to her credit, she was really pushing this as a nationwide conversation. That's what the sustainable finance issue, partly is about. It's that she recognized that student loan is part of the systemic risk problem. So you guys have a voice. I mean, you're students. You are both the beneficiaries and the people carrying the burden because you got the student loans. I mean, so you need to push back, and you're not going to sacrifice your education. You're going to go into debt just like I did because I couldn't live off $18,000 in New York, right? So I got no undergrad debt, but in grad school, yeah, even though I had the free tuition waiver and all that stuff, didn't have to pay taxes. I mean, $18,000 a year is a tough way to live in New York. So, as Richard can attest, right? So I think you guys have a role to play in making your voice heard about this, about the affordability of college. And once you graduate, to continue to advocate for it, because you're front line. I mean, students are front line because you're gonna have to start paying those loans back. And you're gonna do everything you can to pay those loans back, right? But there's interesting efforts to get rid of this, do student loan jubilees, to just completely forgive it. I mean, that would be a sweetheart deal for you guys if you want to get involved. You got to hang out with Occupy Wall Street kids, but hey, you actually have solidarity with them if you got student loans. Yeah. So there's a lot of different stuff to do, but it's super complex, and that's what finance does. It creates complexity and makes it difficult to pierce it. But from an investment point of view, last thing I'll say on it is to do what we're starting to do at the Institute, which is call it the credit rating agencies. Call out Navient, say, this is crap you guys have put in this. You still have these uncleared derivative swaps that are structuring these things. These things blow up. You're going to expect whatever, Deutsche Bank to be bailed out or whomever is underneath it. Yeah.
I wanted to ask more about the slabs.
Yeah.
'Cause I've never heard about slabs until you brought it up today. And I was interested in the risk factor. And could you explain more about the risk? Because you were saying how there's less likely of a chance of us defaulting when we have to pay those.
Right.
But the Moody's credit rate, or the Moody's rating is high on these slabs, but in reality, we owe so much money that we're never going to be able to fully pay it back.
Yeah.
But so how does that? I mean, I don't really fully understand the risk. Is it high risk, these slabs?
Well,
theoretically?
right. That's the ultimate. People say, no, they're not high risk because the government has the power to force you to pay them back, right? To refuse to allow you to discharge them in bankruptcy. Now, how you do that is a little unclear, right? That's when we get to I thought bonds are about social good. So how you can't pay them back, you want to go into bankruptcy. Maybe you can discharge everything else in bankruptcy, but not your student loans. So from an investment perspective, you see that as a guarantee. It's a loan guarantee is what it is. You're guaranteed to be paid back. But if you actually look at a Navient security, those are contracts. It's just a bundle of contracts, basically. Your contract, your loan is a contract. All those contracts are bundled up together, and then you got the counterparty contracts structuring the security. Well, what's happening is that the issuer, Navient, is seeing that students are defaulting their loans. They're not paying them back. They can't discharge them in bankruptcy. So the cash flow is not coming into the security to pay out the investor. That's how it works. Basically, you guys are providing the cash to the investors.
So this is kind of exactly what happened, the financial crisis. And
Right.
Securities.
Exactly.
Okay.
Yeah.
And there could be a massive blow up in the next.
That's right. But 1.2 trillion is a lot. Housing was, Richard, 8 trillion. So we're not quite at the systemic risk levels with student debt because
it's still
lots of working class people don't have student debt. They don't have higher ed. Not everybody goes to college. So it's still, contained from a systemic risk perspective. But it's very troubling to those of you who are implicated by it as investors or as borrowers, right? But what's interesting is that the contracts are now being revised. The investors are seeing that they're saying, okay, we see defaults, therefore we're going to turn this, call it a 20-year slab. We're going to revise the terms to make it a 30-year slab. That should be immediate downgrade. That means the credit quality of that is deteriorating. Moody's isn't downgrading them when that happens. That's the risk. And so if you're attuned to this as a social investor, as a sustainable investor, that's exactly what you want to be asking about. It's okay, I read the Bloomberg term, I see all that, and now there's ESG data that flows into it, but there's a lot more. If you're an ESG investor who cares about environmental social governance, you're concerned about the governance of that slab, because it's pretty dodgy, and you're concerned about the social risk associated with it. So you're going to ask more questions, and you're probably going to be, like the guys in The Big Short, you're going to be on top of it. And then you will short that and make money, potentially. Richard.
Before we allow these students to go on to their next spot in the morning, first I want to thank, I'd like to thank you on behalf of faculty, I'd like to thank you on behalf of the students. there were three words that you used towards the end that sort of resonated with me. And as the students in the class know, I love to use sports analogies because I think there's a tremendous parallel between sports and investing. And as I look at the last week or so, I always admit my bias. And as my friends over here know, I'm a New York Giants fan.
Right.
And there's a lot of turmoil in the Meadowlands over the last week or so. However, a wrong was righted this week. 2 people fired, and somebody got their job back again. And one of the reasons they did was because of 3 words that you used, and that's use your voice. The fans in the New York area use their voice. And I think that it's very, and we're heard. And I think it's very important in what you're talking about, that students use your voice as well. Because frankly, my generation, I'm sorry to say, hasn't left me with a lot of good things. What was you heard about the student debt and climbing, and Lord knows about a planet that needs to be cleaned up a lot. And so I think through your voice and things you do, and something you're learning here, learn in this class, learn from all of your faculty members, you guys will be rewarded. So with that, I say, Josh, thank you very much.
Thanks for having me. Say again?
We're going to get you back again.
Yeah, happy to. I always like coming back to the Eastern Shore. So, and I'm happy to stick around. I know I saw a bunch of hands go up, so I'm happy to stick around and answer other questions that I wasn't able to. Yeah, thanks.